If you are thinking about buying Take-Two Interactive stock right now just because GTA 6 is coming out, stop, put your wallet away and watch this video first. Everyone on the internet is screaming that Take-Two is guaranteed free money, but today we are going to look at the actual math, the historical data, and the real market trends. By the end of this video, you'll know exactly whether you should buy in or stay far away. Let's break it down. Don't buy Take-Two Interactive stock just because GTA 6 is coming. Not because Take-Two is a bad company, not because GTA 6 will fail, and definitely not because Rockstar is losing its touch. The real reason you need to hold off is much more dangerous. And the craziest part? This exact story has already happened once before. But before we dive into the numbers, a quick disclaimer. I am not a financial advisor, and this is not financial advice. This video is for research and education only. Always do your own homework before putting your hard-earned money on the line. Now let's rewind. When GTA 5 launched in September 2013, Take-Two stock opened at just $17.70 a share. Today, it trades right around $258. If you had taken $1,000 back then, bought the stock, and simply went to sleep for a decade, you would be waking up to nearly $14,600 today. That is the dream retail investors are chasing right now. The logic seems flawless. GTA 6 releases, Take-Two makes billions, the stock skyrockets, and everyone makes easy money. But this exact mindset is a trap designed to swallow new investors. Here's the harsh truth. The market isn't sitting around waiting for you to discover GTA 6. Wall Street already knows it exists. Institutional investors already have the release date modeled into their algorithms. Everyone with a brokerage account knows that Rockstar owns the most profitable entertainment franchise in human history. So the question isn't, will GTA 6 be massive? Of course it will. The real question is, how much of that success is already baked into a $258 stock price? Let's look at the actual data and the future price predictions. Right now, Take-Two is trading just about 2.5% below its absolute all-time high of $262.29, which it hit back in October 2025. This stock isn't cheap, and it isn't flying under the radar. It is sitting at its absolute peak right before the biggest launch in gaming history. Out of 29 major Wall Street analysts, the general consensus is a buy, with an average target around $284 to $290 over the next year. But let's look at the extremes to understand where the price could actually go. The most aggressive projection comes from Bank of America, pushing a $368 target. Their logic is that the next iteration of GTA Online will be a massive recurring revenue machine for years to come. If the retail FOMO hits a boiling point as we get closer to November and hype completely takes over the market, we could realistically see the stock price surge toward that $370 mark, or even briefly break past $400 in a perfect storm of positive momentum. But you have to look at the flip side. The lowest analyst target is sitting way down at $170. That means the realistic future of the stock isn't just a guaranteed climb to the moon. It is a massive swing between $170 and $368. If you buy in at the current price of $258, there's very real risk on the downside if expectations aren't perfectly met. This leads to a massive misunderstanding I see everywhere. People look at the market and see Nvidia trading around $195 and Tesla trading around $410. Then they look at Take-Two at $258 and think, wait, Take-Two costs more per share than Nvidia? That stock must be incredibly strong. Wrong. A share price by itself tells you absolutely nothing. Nvidia is a $4.7 trillion titan. Take-Two is worth roughly $45 to $48 billion. Nvidia is nearly 100 times larger, despite having a lower price per share. If you want to know how expensive a stock actually is, you look at the forward PE ratio, which tells you how much you are paying for the company's expected future earnings. Nvidia's forward PE is around 21.7. Take-Two's forward PE is a massive 37.9. Relative to what they are expected to earn, Take-Two is currently priced more expensively than the biggest AI company on the planet. That is the metric that matters, not the price tag on your screen. So, what actually happens when the game drops? There are 3 realistic scenarios. Scenario 1 is absolute perfection. GTA 6 shatters every record, reviews are flawless, and the new online mode is an instant goldmine. The stock pushes toward 300, 350, or beyond. But even then, it won't be a straight line. Investors love to buy the rumor and sell the news, so expect turbulence even if the game is a masterpiece. Scenario 2 is the priced-in drop. The game is a massive success, but it simply meets expectations instead of blowing them away. Maybe the PC port is delayed or the online monetization isn't clear right away. Because near perfect expectations are already priced into that $258 share price, the stock could actually drop despite the game doing well. Scenario 3 is the disaster, a major delay, catastrophic launch bugs, huge backlash over pricing, or lack of physical discs. When a stock is sitting at an all-time high, disappointment hits twice as hard. The fall from this height would be brutal. So, should you buy Take-Two before November? Not blindly, not emotionally, and definitely not with your entire budget all at once. If your plan is to take $1,000 and dump it into Take-Two today, right at its peak, banking on a single video game launch, you are taking a massive gamble. The smarter, calculated play is to scale in. If you want exposure, buy in small batches. Take $100, buy a fraction of a share. Wait a few weeks. If the price drops, your next $100 buys more shares at a discount. If it climbs, you are still making a profit. You stay in the game, but you remove the risk of betting your entire portfolio on one single entry point. Take-Two owns Rockstar, 2K, Red Dead, and Borderlands. It is a phenomenal company, but a great company at the wrong price is still a bad trade. Watch the valuation. Watch what is already priced in. And if you buy like a smart investor who accepts the risks, not a gamer blinded by hype. Drop a comment below. Are you buying Take-Two right now or waiting for a post-launch dip? Subscribe for more analytical market breakdowns, and I'll see you in the next one.